Today, there is an important financial update that could directly affect how money moves in and out of your bank account, especially if you receive Social Security, SSI, SSDI, VA benefits, pension payments, or any type of federal assistance. A new banking rule has officially been approved, and while it may not sound dramatic at first, it could influence how quickly your payments arrive, how your account is monitored for fraud, and what happens if there is an issue with your deposit. This update is connected to broader efforts to strengthen the safety of electronic payments, protect seniors from financial scams, and improve oversight of direct deposit systems used by federal benefit programs. In this video, everything will be explained clearly and step by step so you understand exactly what this means for your account and your monthly income. The new rule focuses primarily on electronic fund transfers and the way financial institutions verify, monitor, and process government-issued payments. Over the past several years, there has been a significant rise in fraud targeting older Americans. Criminals have increasingly attempted to redirect Social Security deposits, intercept stimulus payments, or manipulate bank accounts through identity theft. As a result, federal authorities have approved updated banking standards designed to reduce fraud risks, increase verification procedures, and add stronger reporting requirements for suspicious activity involving government benefits. For seniors who rely on direct deposit, this means banks may now apply enhanced identity verification measures, particularly when changes are made to account information. If someone attempts to update routing numbers, switch deposit accounts, or redirect benefit payments, additional confirmation steps may be required. These safeguards are meant to prevent unauthorized changes that could delay or steal benefit payments. While these protections strengthen security, they may also cause short processing delays in certain situations, especially if account information is inconsistent or incomplete. Another part of the approved rule involves real-time monitoring of large or unusual transactions connected to government deposits. If a Social Security or pension payment is deposited and immediately transferred out of the account in an unusual way, banks are now required to review the activity more carefully. This does not mean payments will automatically be frozen, but it does mean financial institutions have a stronger obligation to pause suspicious transfers long enough to verify legitimacy. For seniors, this could actually be beneficial as it adds another layer of protection against scams that pressure victims to move funds quickly. The rule also strengthens coordination between federal payment agencies and financial institutions. When a payment error occurs, such as an overpayment or an incorrect deposit, banks must now follow updated procedures to return or correct the transaction. In the past, resolving such issues could take weeks. The new guidelines aim to create a faster correction process while still protecting account holders. Seniors who receive monthly benefits may notice that correction notices are handled more efficiently, although communication from banks may become more detailed as part of transparency requirements. Another important area affected by this rule is direct deposit enrollment and modification. For individuals signing up for Social Security or pension benefits for the first time, banks may require stronger identity documentation during account verification. This is part of a broader fraud prevention initiative designed to stop identity thieves from opening accounts in someone else's name and diverting government funds. While the majority of legitimate beneficiaries will experience no major disruption, the added checks are intended to close loopholes that criminals have previously exploited. This update is especially relevant because more than 99% of Social Security payments are now delivered electronically. Paper checks have largely been phased out, and direct deposit has become the standard method for receiving federal benefits. As digital payments increase, so does the need for updated safeguards. Federal authorities have emphasized that this rule is not designed to restrict access to funds, but to ensure that payments reach the correct recipient safely and consistently. In addition to fraud prevention, the rule introduces clearer guidelines on funds availability. Some seniors have experienced confusion about when deposited benefits are fully available for withdrawal. Under the updated standards, banks must provide clearer disclosure about processing timelines and any holds placed on deposits. In most cases, federal benefit payments remain available the same day they are received. However, if an account is newly opened or flagged for unusual activity, temporary holds may occur while verification is completed. For retirees living on fixed incomes, even a short delay can create stress. That is why understanding this rule is important. If you plan to change banks, update account numbers, or modify direct deposit instructions, it is wise to allow additional time for processing. Making updates well before your expected payment date can help prevent disruptions. Keeping personal information accurate and consistent across all accounts also reduces the chance of verification issues. Another component of the rule involves stronger consumer notification requirements. Banks must now notify account holders more quickly if suspicious activity is detected involving federal deposits. This early alert system gives seniors more time to respond if unauthorized transactions occur. Many institutions are expanding text message alerts, email notifications, and automated call systems to meet these requirements. Staying enrolled in your bank's alert program can provide an added layer of protection. The new banking standards also connect to broader efforts to protect stimulus and emergency relief payments. During recent years, large-scale federal relief programs revealed weaknesses in payment tracking systems. Some payments were misdirected due to outdated account information, while others were targeted by scammers. The approved rule attempts to strengthen oversight mechanisms before any future stimulus or relief programs are distributed. If new payments are authorized in the future, these enhanced safeguards are expected to improve accuracy and reduce fraud losses. For seniors receiving pension payments from private employers, in addition to federal benefits, similar protections may apply depending on the bank's internal policies. Many financial institutions are aligning their procedures with federal standards to maintain consistency across all electronic deposits. This means the impact of the rule could extend beyond government benefits and influence how private pension deposits are monitored. As well, it is important to understand that this rule does not reduce benefit amounts, eliminate eligibility, or change payment schedules set by federal programs. Monthly Social Security, SSI, SSDI, and VA benefits continue to follow their established payment calendars. The rule instead focuses on the banking side of the process, specifically how funds are verified, protected, and transferred once they enter the financial system. Another key detail involves joint accounts and representative pays. If a senior has a representative payee managing benefits, banks may require updated documentation confirming authorization. This ensures that individuals handling funds on behalf of beneficiaries are properly registered and verified. While this may require additional paperwork in certain cases, the goal is to prevent misuse of funds intended for vulnerable individuals. Over time, these changes are expected to reduce fraud losses and improve confidence in electronic benefit delivery. However, during the transition period, some seniors may experience additional identity checks when contacting their bank. For example, customer service representatives may ask more detailed verification questions before discussing account information. This is part of compliance requirements tied to the new rule. Financial experts have noted that identity theft targeting older Americans has grown steadily, with criminals using increasingly sophisticated methods. Phishing calls, fake emails, and impersonation schemes often attempt to trick seniors into revealing account details. The strengthened banking procedures aim to create multiple checkpoints that prevent criminals from accessing funds even if they obtain partial information. In practical terms, seniors can take proactive steps to align with these changes. Maintaining updated contact information with both benefit agencies and banks ensures smooth communication. Regularly reviewing account statements helps identify unauthorized transactions early. Avoiding rushed financial decisions, especially those involving urgent requests for wire transfers, reduces exposure to scams. As the financial system becomes more digital, security upgrades become necessary. While any regulatory change can feel concerning, this approved banking rule is largely centered on protection and accuracy. It reflects lessons learned from past fraud incidents and aims to strengthen trust in the direct deposit system that millions of retirees depend on each month. In the next part of this discussion, the focus will shift to how this rule interacts with potential future stimulus payments, how overpayment recovery procedures may be influenced, and what specific scenarios could temporarily affect account access. The goal is to ensure every senior understands not just the policy itself, but how it may operate in real-life situations that impact daily finances. As this new banking rule moves fully into effect, It is important to understand how it connects to future government payments, including any potential stimulus programs, cost of living adjustments, or emergency financial relief that may be approved. In recent years, federal agencies such as the Social Security Administration and the U.S. Department of the Treasury have relied heavily on electronic transfers to distribute funds quickly. When large volumes of payments are issued at once, even small system weaknesses can create delays or expose accounts to fraud. The newly approved banking standards are designed to prevent those weaknesses before future mass payments are sent. If additional relief payments are ever authorized for seniors, banks will now be required to apply stronger account matching systems before releasing funds. This means that names, social security numbers, and account details must align more precisely with federal records. For most retirees who have consistent information on file, this process will happen automatically in the background. However, if there are discrepancies such as a misspelled name, an outdated account number, or conflicting identity data, payments may be temporarily flagged for verification. These safeguards are not intended to block legitimate benefits, but they may require short review periods in rare cases. Another important area influenced by the rule is overpayment recovery. Sometimes benefit agencies determine that an incorrect payment amount was issued. In the past, reversing or adjusting those payments could involve long administrative processes. Under the new framework, banks must follow clearer procedures when receiving official instructions to correct deposits. This may allow adjustments to happen more efficiently, but it also means banks must carefully confirm that any reversal request is legitimate before acting. This additional confirmation protects seniors from fraudulent attempts to withdraw funds under false claims of overpayment. For retirees who manage tight monthly budgets, the timing of deposits is critical. Social Security payments typically follow a structured schedule based on birth dates, and supplemental security income generally arrives at the beginning of each month. That payment calendar remains unchanged. What has changed is the back-end monitoring system that protects those funds once they arrive. If suspicious activity is detected shortly after a deposit, a bank may temporarily restrict certain outgoing transfers until verification is complete. While this may feel inconvenient in the moment, it is designed to stop criminals who pressure victims into moving money immediately after it arrives. The rule also strengthens reporting requirements for financial institutions when fraud attempts are detected. If a bank identifies patterns suggesting organized scams targeting seniors, it must report that activity more quickly to federal oversight bodies. This coordinated response helps authorities identify emerging scam trends faster. In practical terms, this creates a broader safety net around retirement income, especially for older Americans who may be targeted through phone calls, text messages, or online impersonation schemes. It is also worth noting that banks are increasing education efforts for account holders as part of compliance with these new standards. Many institutions are providing clearer explanations about how direct deposits work when funds become available and how to recognize suspicious requests. Seniors who take advantage of account alerts, fraud monitoring services, and regular statement reviews place themselves in a stronger position under this updated system. For those who receive both federal benefits and private pension payments, the improved monitoring procedures often apply across all electronic deposits. Financial institutions prefer consistency, so the same fraud detection technology used for government payments may also monitor other incoming funds. This creates a more unified protection structure within your account. It does not reduce your access to your money, but it does increase the chances that unusual activity will be caught early. Another important detail involves beneficiaries who change banks. If you decide to open a new account and redirect your direct deposit, it is wise to complete that transition well in advance of your next scheduled payment. Because verification procedures are now stricter, last-minute account changes may trigger review steps that could briefly delay a deposit. Planning ahead minimizes the risk of interruption. Once verification is complete, future payments should proceed normally. For seniors who rely on representative pays or joint account holders, keeping documentation updated is especially important. Banks may request confirmation that the authorized person handling benefits is still properly designated. This step protects vulnerable beneficiaries from unauthorized access. While it may require providing identification again, it strengthens accountability and transparency. It is equally important to clarify what this rule does not do. It does not reduce monthly benefit amounts. It does not change eligibility requirements for Social Security, SSI, SSDI, or VA benefits. It does not eliminate pensions. It does not create new fees for receiving federal deposits. Instead, it focuses on the safety, verification, and correction processes tied to electronic banking systems. Any impact on seniors is primarily related to enhanced security checks, not reductions in income. Financial stability in retirement depends on predictability. When deposits arrive on time and accounts remain secure, seniors can confidently manage housing, food, medical expenses, and daily living costs. The purpose of this approved banking rule is to reinforce that predictability by addressing vulnerabilities that have emerged in the digital age. Fraud attempts have grown more advanced, and regulatory standards must evolve to keep pace. In the long term, stronger safeguards may reduce the number of benefit disruptions caused by identity theft. When criminals fail to redirect payments or access accounts, seniors experience fewer financial shocks. Although added verification may occasionally require patience, the broader goal is to create a more resilient payment system that protects retirement income nationwide. Understanding these changes allows you to remain prepared rather than surprised. Keeping personal information updated, responding promptly to legitimate bank communications, and monitoring account activity regularly are practical habits that align with the new standards. These steps help ensure that your Social Security, pension, or any future relief payment continues to arrive securely. This update reflects a broader modernization of financial protections in the United States. Electronic deposits have become the backbone of benefit distribution by strengthening oversight at the banking level. Federal authorities aim to secure that backbone for years to come. For seniors living on fixed incomes, stability and protection matter more than ever. As we conclude, remember the key takeaway. A new banking rule has been approved to improve security, strengthen fraud prevention, and enhance oversight of electronic deposits connected to federal benefits. It does not cut your payments or change your eligibility. It adds protective layers designed to ensure that the money intended for you reaches you safely and remains in your control. Staying informed, maintaining accurate account information, and monitoring your finances regularly will help you navigate this update confidently. Your retirement income is essential, and these safeguards are meant to preserve it with greater reliability and trust moving forward.